Today, we're going to be going over qualitative characteristics and accounting assumptions. Think of qualitative characteristics and assumptions as basic rules that accountants and their reports have to follow. This ensures that information is correct, clear, and useful. These golden rules, so to speak, are the fundamentals of VCE accounting, so you should make sure to remember the key parts of the definition and always include them in your theory answers. There are 4 overall assumptions and 6 characteristics in the study design. I like to remember the 4 assumptions by this acronym here, PAGE. And this stands for period assumption, accrual, going concern, and the entity assumption. The period assumption makes sure that reports are always prepared within consistent time periods. This can be any time period, ranging from a month to 6 months to a year, really whatever the business decides it wants to be. By preparing them in consistent time periods, this makes it easy for accountants to compare the results between periods, because you could imagine it would be very difficult to compare the profit from one period to another period if you're constantly changing the duration of each of them. And as you can see here, I've also got the VCAA definition straight from the study design here. VCAA doesn't expect its students to remember the entire definition word for word. So instead, you should aim to remember the summed up version that I've created here in the red box. Try to remember this word for word so you can throw them in your theory answers to really stand out. Next up, we have the accrual assumption, which states that revenue must be recognized when it is earned and expenses when incurred, regardless of when cash is transferred. For example, if a company pays in advance for 6 months worth of rent, they would not report it as an expense all at once. However, only after it is gradually being used up or incurred. In other words, the first month of rent will only be seen as an expense after the month is over and we've used up the rent. Used up, or quote, incurred the rent. This goes for revenue as well. For example, if we receive cash for a product which will be delivered in the future, as we haven't earned it yet, as we haven't delivered it, we cannot record it as revenue until the final item has been delivered and we have, quote, earned the revenue. The going concern assumption is pretty simple, and all it states is that we have to assume that a business will continue to operate into the future and won't be expected to close down anytime in the future. All this does is that it allows businesses to plan for future events without worrying whether they're going to shut down or close. And finally, the entity assumption states that a business must remain a separate legal entity. Therefore, we must only record transactions which relate to the business and exclude all other transactions such as the owner's personal finances. Now it's your turn. Pause the video for a couple of seconds and try to fill in the gaps. Alright, so we have the accrual assumption states that revenue must be recognized when earned and expenses when incurred, regardless of when cash is transferred. 2, the entity assumption states that a firm remains a separate legal entity from the owner's personal finances. And finally, the going concern assumption assumes that a business will continue to operate into the foreseeable future. If you got all those right, well done. 3 big ticks. Now, let's move on to qualitative characteristics. I like to remember these using the acronym here, VCTURF. The first one, V, or verifiability, ensures that financial information is constantly supported by evidence. For example, a receipt must be provided as evidence to verify the accuracy of sales. This ensures that firms have evidence and don't just end up making up numbers from nowhere. Next, C, or comparability, means information can be compared across businesses or time periods relatively easily. For example, if two yearly profit reports follow the same format, owners can easily compare the results between years. Information is more useful if it's able to be compared against something else. Next, we have T or timeliness, which makes sure that information is available to business owners quickly so that it remains useful for business decision making. The older the information is, the less useful it is. For example, changes in consumer preferences. What consumers like 1 month might change as more time elapses and another month comes around. Next, understandability makes sure that financial information is presented clearly and concisely so that even people with basic accounting knowledge can understand the data and understand what it represents. Think of neat, detailed, and well-presented reports which the average person is able to read. R or relevance means that reports and info must be useful for decision making in the business. There's no point in including information which is irrelevant and does not affect the business. Information is determined as relevant if it helps business owners predict future outcomes or confirm past events. Just think, if it affects what the firm does or what they are going to do, it is relevant. Relevance also depends on size. For example, if a business usually deals with millions and millions of dollars on a daily basis, small dollar amounts such as a missing 5 cents or a $5 box of pens won't change any business decisions, so it must be considered irrelevant in the grand scheme of things. But however, a $5 box of pens for a smaller business which only deals with transactions in the hundreds of dollars, as it's more significant, it might be considered relevant to them. Finally, F or faithful representation is probably the easiest and requires that financial information be accurate, free from error and bias, and most importantly, reflect real-world conditions. This ensures accountants are acting ethically and reports are always truthful and well represented. Now it's your turn again. Pause the video and try to fill in the gaps. Information is relevant if it assists users in the decision-making process. Information is understandable if it is presented clearly and can be understood by users with a reasonable knowledge of accounting. And finally, faithful representation, requires information to be free from error, bias, and reflect real-world economic conditions. If this video has helped, I highly recommend you check out the link below. We are currently accepting online tutoring. You'll get full access to exam preparation, practice questions, and personalized feedback at BT Tutoring. Everything's on the website, link below. See you next time.